Hey everyone, and welcome back to your Money Your Way YouTube channel. Today, we are looking at S-REITs as we are in June 2025. This sector is important on the Singapore exchange. For income investors, there is potential value to explore. The S-REIT sector has faced challenges, mainly due to high interest rates. But now, in June 2025, things are changing, suggesting a possible upward trend. Please note that the content presented in this video is for informational purposes only and does not constitute investment advice. We strongly recommend that you seek proper guidance from a qualified financial advisor before making any investment decisions. Let's start with the economic picture. Globally, growth is expected to be stable but modest. Forecasts for 2025 and 2026 are around 3.2% to 3.3%. Global headline inflation should moderate to 4.4% to 4.5% in 2025. However, core inflation might fall more slowly, and risks could keep interest rates elevated. Monetary policy is starting to ease. The European Central Bank cut rates in June 2024. The US Federal Reserve is expected to cut rates by 25 basis points by Q3 2025, potentially more if the economy weakens. This shift reflects concerns about global growth and easing inflation. A major uncertainty is US trade policies and tariffs, like a potential 10% universal tariff on imports, including from Singapore. This adds uncertainty to global trade. In Singapore, the economy is expected to grow moderately in 2025. The Ministry of Trade and Industry forecasts GDP growth at 0.0 to 2%. This is a downgrade, acknowledging trade tension risks. Inflation here is expected to be subdued. The MAS lowered its core inflation forecast for 2025 to 0.5% to 1.5%. Headline inflation is also forecast at 0.5% to 1.5%. The MAS eased monetary policy in January and April 2025. The Singapore Overnight Rate Average, or SORA, might trend around 2.2% in 2026. The unemployment rate is projected to be stable at 1.9% in 2025. US tariffs might indirectly affect Singapore's property market sentiment, especially for higher-value private transactions. But strong demand and government policies offer support. How is the S-REITs market performing? As of May 2025, the FTSE ST-REIT index has moved sideways after recovering slightly from an April flash crash. This crash brought the index close to March 2020 COVID crash levels, linked to renewed US tariff concerns. Valuations suggest the sector is undervalued. The weighted average price to net asset value, or price NAV, fell to 0.76 in May 2025. This means REITs trade at a 24% discount to fair value, a level last seen in March 2020. This could be a compelling opportunity for value investors. Distribution yields, TTM, averaged 6.17% in May 2025. While slightly lower than March, 19 out of 38 S-REITs still offer yields above 7%. This is attractive compared to savings or government bonds. The yield spread over Singapore government bonds also widened. Gearing ratios increased slightly to a weighted average of 38.27% in May 2025. Some REITs, especially those with US office exposure, have exceeded the MAS 50% limit due to property value declines, but there are provisions for this. Key factors driving and challenging S-REITs include interest rates. Falling rates are major positive. Lower rates reduce borrowing costs, making acquisitions and refinancing cheaper. This boosts profitability and DPU, especially for REITs with shorter debt profiles or floating rate debt. Historically, REITs often outperform when rates are falling. Inflation. REITs are considered a strong hedge against inflation. Property values tend to rise, and rental income often adjusts with lease clauses. Economic growth and trade. Subdued global growth and US tariff uncertainty pose risks. Economic cycles affect performance. Cyclical sectors are more impacted than defensive ones. Regulatory environment. MAS regulations on leverage, 50% limit, and ICR, 2.5x above 45% gearing are important. REITs, with overseas exposure, like US office, face challenges from valuation declines and refinancing risks. Foreign exchange losses can also impact DPU for overseas income. Supply-demand. Supply shortages are projected globally for in-demand assets. In Singapore, new private residential supply is low for 2025 to 2027. The industrial sector expects significant new supply in 2025. Core CBD office supply is limited until 2028. Several sectors within S-REITs are projected for strong growth. Data centers, driven by AI, cloud, 5G, and IoT. Strong demand leads to rising rents and low vacancy. Power constraints are a challenge, pushing expansion to secondary markets. Governments support digital infrastructure. Healthcare, stable due to essential services. Benefits from an aging global population. Parkway Life REITs is noted for consistent DPU growth and diversification. Logistics and industrial, high specification, strong demand from e-commerce, tech, manufacturing, and food tech. India is noted as an alternative manufacturing hub. Singapore faces significant new supply in 2025, intensifying competition for older facilities. Government initiatives support demand for quality spaces. Hospitality and tourism. Positive outlook as tourism recovers to pre-pandemic levels in 2025. Singapore projects 17 to 18.5 million visitor arrivals. REITs can adjust room rates daily, offering inflation hedging. Retail, prime and suburban showing resilience. Rents expected to recover to pre-COVID levels. Suburban retail is strong due to new homes and rising incomes. Investor interest is resilient. Residential, strong local demand and critically low new private housing supply for 2025 to 2027. Falling mortgage rates expected to improve affordability. High rental demand from expatriates supports the market. Office, Grade A CBD, resilient demand and modest rental growth expected. Driven by banking, tech, and flight to quality. Limited new supply until 2028 supports rental growth. When choosing S-REITs, focus on these factors: financial health, gearing ratio, preferably below 40%. Regulatory limit is 50%. Lower gearing means lower financial risk. Interest coverage ratio, above 2.5x for leverage over 45%. Higher is better for stability. DPU growth and sustainability. Look for consistent growth and sustainable payout ratios. REITs must distribute at least 90% of taxable income. Price NAV. The current average is 0.76, suggesting undervaluation. Below 1 suggests potential undervaluation. Net property income yield indicates income generation efficiency. Higher is better. Property portfolio, quality and location. High-quality assets in good locations are crucial. Occupancy rates, ideally above 90%. High occupancy means strong income. Weighted average lease expiry, longer, e.g., 5 to 10 years, means more secure income. Diversification, across property types and geographies spreads risk. Over 90% of S-REITs own overseas properties. Sponsor and management. A strong sponsor provides assets and support. Evaluate the manager's track record. Interest rate sensitivity. Fixed rate debt offers stability. Floating rate debt benefits more from rate cuts. Inflation hedging. Look for properties with rent escalators or in resilient sectors like residential healthcare. ESG considerations. Green certified properties are increasingly in demand. Based on growth sectors and factors, here are some highlighted REITs, data center REITs, positioned for potential payout increases. Capitaland Ascenders REIT, exposure to data centers, positive rental reversion, moderate gearing of 38.9%. Occupancy 91.5%. Keppel DC REITs, pure play data center, 14.2% DPU increase in Q1 2025. High occupancy 96.5%. Low leverage 30.2%. Opportunities for acquisitions. Digital core REITs, high occupancy 98%, revenue surge from acquisitions. Sponsor pipeline. Healthcare REITs, offer stability and growth. Parkway Life REITs, consistent DPU growth since IPO. Diversified in Singapore, Japan, France. Healthy gearing 36.1%, 90% fixed rate debt. Singapore hospitals have guaranteed rent step-ups. First REIT, higher yield but DPU fell in Q1 2025. Higher gearing 40.7% and debt cost than P Life REIT. Diversifying into Japan. Retail REITs, stable income and growth potential. CapitaLand Integrated Commercial Trust, largest Singapore commercial proxy. Diverse portfolio. Positive rental reversions. 10.4% retail, 5.4% office in Q1 2025. Occupancy 96.4%. Strong sponsor. Fraser's Centrepoint Trust. Focus on suburban retail malls. High occupancy 99.5%. Positive rental reversion 9% in 1HFI 2025. Benefits from new homes and rising incomes. Diversified industrial REITs. Broad exposure with growth potential. Mapletree Pan-Asia Commercial Trust. Diversified across Asia. High yield despite DPU decline. Positive rental reversion 3.6%. VivoCity Enhancement completing end 2025. Mapletree Industrial Trust. Focus on industrial including data centers. Benefits from strong high-spec industrial demand. Strong sponsor. To conclude, the Singapore REIT sector in June 2025 is at a key point. Global uncertainties exist, but expected easing of interest rates and Singapore's stable economy are positive factors. The current undervaluation, trading at a large discount to NAV, offers potential for both value appreciation and income. Key recommendations: focus on data centers, healthcare, and high-spec logistics industrial. These have long-term demand drivers. Check for strong financials, healthy gearing below 40%, and high ICR above 2.5x. Evaluate portfolio quality, high occupancy, and diversification. Look for long WALE. Consider interest rate sensitivity based on debt structure. Floating rate debt may benefit more from cuts. Seek strong sponsors and capable management. Consider the current undervaluation, price NAV 0.76, as a potential entry point. Remember, investing requires careful research. This information provides a starting point. What are your thoughts on S-REITs? Let us know in the comments. If you found this helpful, please like this video and subscribe for more insights. Thank you for watching.